Hi, let's go over net listings. Net listing. A net listing could be either an open listing, an exclusive agency listing, or an exclusive right of sale listing. What creates a net listing is how the broker's commission is calculated. With a net listing, the seller agrees to take an amount that the seller will receive after all selling costs. The broker's commission is part of the selling cost. After all expenses of the sale are paid, less the amount agreed to be paid to the seller, the broker receives the remaining amount as the commission. This is a bilateral contract. A net listing creates an opportunity for an unethical agent to take advantage of a homeowner that isn't aware of the true value of his or her home. For this reason, a net listing is not legal in all states. It is important to check your state rules requiring net listings. In Indiana, for example, net listings are illegal. In Florida, for example, net listings are legal. A net listing is legal in Florida. However, taking advantage of sellers is not legal under laws of misrepresentation, including misrepresenting the true value of the property. A net listing is a bilateral contract as both the seller and the broker are obligated to perform. Net listing summarized. The seller agrees to a net sale price. The broker keeps everything over this net price. Not legal in all states. Is legal in Florida. And is a bilateral contract. Net listing calculations, story problem 1. A home sold at $410,000 with $5,000 selling expenses and the seller agreeing to a net of $380,000. How much would the broker earn as a commission on the sale? Solution. As stated, after all expenses of the sale are paid, less the amount agreed to be paid to the seller, the broker receives the remaining amount as the commission. So sale price minus closing expenses minus net to the seller equals broker commission. So in this case, we have a $410,000 sale price minus $5,000 in expenses minus the $380,000 that the seller agreed to net to equal $25,000 earned by the broker. Remember, it would be illegal for a broker to misrepresent the value of the home. In the previous example, the broker earned $25,000 on a $410,000 listing. That means that as a percentage, the broker earned 6% on the sale, calculated as $25,000 divided by $410,000. Commission is always negotiable. However, with net listings, brokers need to be especially conscious of not appearing to take advantage of a seller. 6% is a common commission earned by that broker in other deals, then this would be a reasonable deal to move forward with. Avoid misrepresentation. It could be deemed misrepresentation, though, if the seller agreed to netting $380,000 when the house was actually worth $600,000. Instead of selling the house for $410,000, the broker sold it quickly under market at $510,000. In that scenario, the broker could potentially pocket an extra $100,000, which would equal to 25% commission percentage. Something like that would be much harder to argue as being reasonable. Particularly if the seller is shown later to be out of touch with the market, let's say an elderly woman who bought the home 50 years before at $50,000. A broker considering a net listing would be best guided to do two things. First, determine how much the seller wants to net. Using this information, determine how much the house would have to sell for to pay the broker an average commission while producing the net to the seller. Second, compare this amount to how much the house would be expected to sell for compared to other properties sold. See section 16 for more about determining expected sales price. Calculating required sale price based on net listings. Following is the formula to use for net listings. First, you need to calculate the seller's percentage of the sale. You can do that by subtracting the percentage of the commission that the agent is planning to receive from 100%. You then calculate the expected selling expenses. Expenses such as title insurance, title closing fee, title search fees, recording fees, documentary stamp on the deed, property taxes, HOA estoppel fee, mortgage payoff, and any expected repairs. Third, calculate selling price. The final step is to take the amount that the seller wants to net plus the expected selling expenses, add those two together, and divide that by the seller's percentage of the sale. This will equal the required sale price. Example. Here is an example of the net listing formula being utilized. First, we have the seller's agreed upon net. The seller would like to walk away from the sale with $200,000. The expected seller fees and expenses for the deal is $5,200. So we can add our seller net with our seller fees and expenses together to give us $205,200. Our broker is planning to net 6%. So by taking the 6% minus 100%, that gives us the seller's percentage, which is 94%. So we divide our $205,200 by the 94% to give us our required sale price, which is $218,298, rounded up. Net listing calculations, story problem 2. A seller wants to earn $150,000 on the sale of her home. The agent expected seller closing costs to be $3,000, and the agent wanted to earn 5% in commission. What price would the home have to sell for? Net listing calculations, solution 2. Solution. First, calculate the seller's percentage of the sale. To do that, you take 100% and subtract the commission percentage of the agent. And in this case, the agent wants to net 5% commission. So you take 100% minus 5% to equal 95% seller's percentage of the sale. Then second, calculate expected selling expenses, which we're being told is $3,000. Third, add the seller expected net plus the selling expenses together, which would be $153,000, 150,000 plus 3, and divide by the seller's percentage of the sale, which is 0.95. So $153,000 divided by 0.95 equals $161,053. Rounded up, that would be the amount that the property would have to sell for in order to cover the seller's expected net, the selling expenses, and the 5% commission. I must admit that I'm not a big fan of net listings. That's probably because I come from Indiana, and in Indiana, net listings are illegal. The rationale in Indiana is that the concept of net listings is an invitation to take advantage of someone who really doesn't know the market. But I do understand and agree with Florida's stance that just because net listings are allowed, it is not an invitation to deceive, misrepresent, or take advantage of someone. If you are going to take a net listing, I suggest that you document in a file the expected sales price based on other recent sales that compare to the property. Plus, document discussions about value with the seller. Document discussions about expected expenses. That way, if you earn a higher commission than you normally do, you have a record showing the steps that you took to make sure that the seller was making a well-informed decision. To a certain extent, all listing presentations are a bit like calculating net listings. Once you get past the initial licensing course, agent training will concentrate on how to get listings and how to determine the best listing price. And it will also concentrate on how to get the seller to agree to a selling price that will result in an actual sale. In the end, whether talking with the seller about a listing contract or an offer from a buyer, the seller's main focus will usually be on how much the seller will net from the sale.